Hey, welcome back to the channel. I'm Doug, the Retirement Guy. Today we have an awesome video for you. The weekly paying top 8 ETFs with no NAV erosion. We searched and looked through all of the 60 plus weekly paying ETFs to give you the top 8 and eliminate all NAV erosion, especially in the troubled times today. So before we get into it, I got to give a shout out to all of our Patreon supporters and all of our YouTube subscribers. If you're not a subscriber, don't be afraid to hit that subscribe button. Hit that bell notification. You definitely don't want to miss a single one of the videos that we put out. Let's get into today's video. Notice to all viewers, past performance does not guarantee future results. This is for educational and informational purposes only. I am not a financial advisor, nor do I offer this as financial advice. If you're looking for financial advice, always contact a financial advisor. So the methodology that I used to analyze all this, the criteria, is evaluate the framework for weekly pay ETFs with no NAV erosion. So of course, each one had to have a weekly distribution schedule, and each ETF must have the potential of paying dividends on a weekly basis. Now I looked back at the confirmed pay history that was currently recorded from the ETF supplier, and then looked at the consistency and the distribution frequency that they've been able to do. The NAV stability. I wanted to find funds that analyzed the NAV performance and made sure that we had no NAV erosion, long-term erosion, and their net asset value was stable. And then I wanted to rank them by yield, as of who basically is paying out the highest amount or giving me the potential for the highest dividend yield across the board. So once I did that, I listed them out and I came up with 8 products that met every one of the criteria that we asked for. So I want to make sure everyone understands that the NAV erosion in high yield ETFs. What is NAV erosion? And the NAV is a gradual decline in the fund's net asset value over time. So a fund can always have what I classify it as price adjustment, market conditions, or price adjusting. So the graph that I used, and I've used this in other videos before, if you had a fund that was, the NAV value was $100, and after 1 year the thing was up to 110, and second year was down to 100 again. From year 2 all the way to year 4, when you see a consistent drop from 100 down to, we'll call it $90, that's NAV erosion. Now, when you see a lot of funds that will go up, down, people always call the downward trend NAV erosion. And that's not really true. That's a lot of times market conditions. So NAV erosion, you want to see it over a long period of time, so you can classify that. So let's take a look at the very first fund, and that's going to be MAGY from Round Hill, the Magnificent 7 Covered Call ETF. This one comes in at number 8. The Round Hill Magnificent 7 Covered Call is an exchange-traded fund that mostly invests in stock base on a particular theme. The fund uses a fund-of-fund approach to provide current income and cap gains of the Magnificent 7, which is your Amazons, your Googles, your Facebook or Meta, Tesla's in there, and they do it through a covered call strategy. The fund provides long exposure to that Magnificent 7, which is tech companies, while both standardizing the exchange trade and the flex options. Now, this launched in April of 2025 by Round Hill. And Round Hill has had a very respectable name when it comes to the weekly ETFs. Now, so far from the information posted, and remember, this stuff changes, can change minute by minute, can change day by day, But when I ran the numbers on this one, we came up with a 34% dividend yield with a year-to-date of 4.50% growth for a total return of 38.50%. Now, the expense ratio is 0.99%, and the assets under management are $161 million. Now, you can see in the chart as we pulled this up, this is a year-to-date chart, so January all the way up to currently here in November. It has had some drop-offs, but its overall performance is up that 4.5%, and that's including the drop-off that we're seeing in the past 2 days here in November. So very, very strong program, very strong ETF. But you remember, these things can change in a quick basis. Number 7 is BLOX, the Nicholas Crypto Income ETF. Now, this one is a little bit different of an ETF as a way it trades. The Nicholas ETF is an exchange-traded fund that mostly invests in target outcome asset allocations. The fund is actively managed and consists of crypto company stocks, not just crypto itself, but the company stocks, the underlying funds that provide exposure to Bitcoin and Ether, and the options overlay. The fund does not directly invest into cryptocurrencies. So BLOX has launched in June of 2025. And it's probably I personally think one of the strong crypto plays that are out there, because they don't do the crypto. They do everything around the crypto. So they're looking at the miners, they're looking at the chip companies, they're looking at a lot of things under the hood of crypto. Now their dividend yield is 36%. Year to date, 17.77% growth for a year to date total of 53.77%. Now the expense ratio is a little bit higher, but 1.03%, with assets under management of $202 million. Now I note on here that this is an option overlay. So options are only a slight part of what gives BLOX its power behind its growth. And you look at the chart below and you'll see the fund has so far had some good potential of growth across the board at that 17.77%. Our number 6 fund is going to come to you from the Yield Max fund, which is their fund CHIP, CHPY. It's a semiconductor portfolio option income ETF. Now, I know a lot of you out there have always said Yield Max is trash, Yield Max is terrible, but Yield Max does have some good products. You just have to pick through what they offer you. And with the Yield Max semiconductor portfolio, this one mostly invests in informational technology equities. The fund is actively managed, and it has about 15 to 30 U.S. listed semiconductor companies. It's a complex option strategy that they use. The fund seeks to provide income and secondary capital appreciation. For me, this is why I like this fund and why I had to have it in my at number 6 spot. For the reason is they are looking for capital appreciation. They are trying to grow the fund. This one launched on April 2nd of 2025. They have a dividend yield of right now 40%, a year-to-date growth of 17.73% for a total of 57.73%, a 0.99% expense ratio, and an asset under management of $116 million. You look at the chart across the board, they have had a good season, they've had a good year, they've had some good growth, and you're finally seeing some drop-offs here with the conditions that are out in the marketplace here starting off in November. But I personally am very pleased with what this has done, and it's a solid one in my portfolio. At number 5 NVII from the REC shares NVIDIA Growth and Income ETF. Now, REC shares is not a I'll call it well-known brand out there. A lot of my viewers don't always do much with the REC shares, but they have a very unique way of doing things. The fund seeks to provide weekly distribution through a synthetic covered call strategy on NVIDIA. But it also is aiming at that 105 to 150% of the NVIDIA's daily share price performance. Now, it is an actively managed fund that uses standardized exchange trade and flex options, but they also use 50% of their market to go for the upside for growth, while they use the other 50% towards potential income generation. This one has had a dividend yield of 44%, a growth rate of 19.53% for a total of 63.53% return, an expense ratio of only 0.99%, and they have an assets under management of $54 million. They do a very unique system with that 50-50 split. And when you look at the chart, you can see that they've had so far this year a very positive overall growth and maintaining the income versus growth pattern. At number 4, TSII, another REC share, Tesla Growth and Income ETF. This one uses the same exact system as we just talked about, except that it goes with the Tesla stock. So this one has a 74.0% dividend yield, a 10.80% on the growth, for a total return of 84.80%. The expense ratio 0.99%, with $20 million under assets under management. When you have the Tesla volatility, you have the potential for the increased dividend yield. And they also have that 50-50 mix, so you're getting the capital growth on the fund with that same potential. At number 3, came in at HOOW, the Round Hill Robinhood Weekly ETF. Now, I have to put a note out there on this one. This is one of my favorite funds that I personally own. Been very pleased with the performance that it's done in my portfolio. So the Round Hill Robinhood Weekly Pay invest in financials equities. The fund is actively managed and seeks to provide weekly distributions and 1.2 times leverage exposure to the weekly price return of Robinhood markets. This one launched in June 18th of 2025. The dividend yield so far has been a 91%, with a year-to-date growth of 26.89%, for a total year-to-date total return of 117.89%. The expense ratio is 0.99%, and assets under management $271 million. Now, this fund tracks very, very close to the Robinhood stock, and they use unique different ways of doing their options and doing their leverage exposure on the fund. So this one has a lot of volatility, and it does have a lot of price adjustments up and down. So this is one of those funds that is not a set and forget. This is a fund that does need to be babysat and does to be watched. Now, number 2, it comes back from the Yield Max, and that is their PLTY option income strategy. Now, this fund here is a technology equity. The fund seeks to provide income and capped gains on PLTY technologies through a synthetic covered call strategy, colorizing by cash and U.S. Treasuries. This one launched October 7th of 2024, so it's over 1 year old already, and it was issued by YieldMax. The dividend yield is 101. The year-to-date growth, unfortunately, is down 18.29%. Now, I will tell you this is not NAV erosion. And when you look at the chart, you will see this is not NAV erosion. This is just a fund that has had market fluctuations because of the high volatility that they are playing in with the PLTY product. And when you get into this is working with a lot of different parts of the crypto market. So this one ended up at 82.71% total year-to-date return with assets under management of $662 million. Now the expense ratio is the highest one that we have in the portfolio, and that is 1.44%. Now coming at number 1, this is another yield max product. This is the Robinhood Option Income Strategy. Now this fund seeks to provide income and capped gains on the Robinhood stock through synthetic covered call strategies. It is managed and uses both standardized exchange trade and flex options. This one opened up May 7th of 2025. The dividend yield so far 101 and the year-to-date growth of 14.58% gave us a year-to-date total of 115.58%. The expense ratio was 0.99% with $236 million under assets. So you take a look at the chart here again, follows what does Robinhood fairly well, and it's had a very strong run in the past few months. Now, there's always change, and you can see it's dropped down with the past couple days. It's trying to make a recovery back. So when we take a look at this, our top 8 ETFs ranked by dividend yield. We'll repeat it again. HOOY came in at the 101. The PLTY came at 101, and HOW came at 91. The TSII, the REC shares program, 74%. The NVII program at 44%. CHIP, CHPY at 40. BLOX at 36. And MAGY came in at 34. So very strong portfolio with a nice mix across the board. You have covered calls, you have leverages, you have funds of funds. So one of the things, the big thing I looked at it was that we had no real NAV erosion off of these funds, and that they're paying that weekly distribution. So investment strategy analysis, overview the different approaches to generate the weekly income potential. And as I'd said, a lot of them use a covered call strategy. Some are using that multi-strategy options. And then we have the index tracking, which is more of a leverage style of things. So there's a nice mix across the board in the top 8. So our conclusion is this. My key findings that I found when doing this: yield versus sustainability. High dividend yields are very attractive, but sustainability of the distributions is critical for long-term investing returns. Going through 60 plus different ETF funds, you find a lot of information. That's why I chose to use the yield, the income dividend yield first, and then total return second. The NAV performance, it was shocking, and I know my portfolio has had a few hits lately with NAV erosion. And I wanted to show that there are quality weekly paying ETFs with the potential of good growth and the potential of good income. And that's why I wanted to show that NAV is not always inherent to every weekly fund. So we did a very comprehensive analysis on this. Now, one of the risk factors I always have to put out there, and I will always tell you, is the high yield ETFs with poor NAV performance use a lot of return on capital for investors. And you have to be educated and know that the assets under management is a big factor, and it's a big telltale sign. Leverage ETFs are very, very risky because they are gambling. You may be going up 1.5% over the performance of that one stock, but it also works in the reverse way. So guys, I hope you liked this information. I hope this worked out for you, and I hope it can help in your portfolio as it's done in mine.
Thank you for watching. Press the like button, hit the subscribe button, and join. Leave any comments below and join our Patreon to support the channel. I'm Doug, the Retirement Guy.